Hey guys, today we're going to go over 3 hidden taxes that destroy small business owners. I've seen this so many times. Client is running a successful business. They're reinvesting their money into the business all the time. And at tax time, they think, I've got no money in the account because they've been investing back in their business. So I don't owe any taxes, right? Right? Not so fast, right? Taxes don't care about how much money you have. It is easy to have a massive tax bill while having no money left. And the biggest culprits, well, that's what we're going to go over today. I'm going to show you exactly what those taxes are, why they hit so hard, and what the people who actually keep their money do differently. I'm Toby Mathis. I'm a tax attorney. I've been doing this since the 1990s. I have sat across from thousands of business owners and watched the same mistakes happen over and over. The business owners who avoid things, they're not smarter. They just got the right information before the mistake was made. Not after, before. By the way, drop a comment below before we get started. Tell me what you think the top 3 are. We're going to play a little game here. When I'm done explaining the top 3, let me know which ones you actually knew about and which ones surprised you. Now, I'm going to get started with the one that blindsides most every new business owner. And by the way, this is low-hanging fruit. Everybody knows about this if you spend any time in the tax world. And that is hidden tax number 1, SE tax, self-employment tax. The tax nobody told you about. When you work for somebody else, your employer pays these employment taxes. They're withholding it. And they're paying half of it, actually. It's Social Security and Medicare taxes. You pay half, but your employer's paying half. It comes out of your paycheck automatically, and most people never even think about it. But when you work for yourself, you pay both halves, all of it. Every dollar, the rate is 15.3%. That's 12.4% for Social Security, which is old age, disability, and survivors benefit insurance, and 2.9% for Medicare. And it hits even before income tax gets started. So let me show you what this actually costs with real number, because there's a lot of bad information out there. So let's just say you make $100,000 as a sole proprietor. And I'm just going to pick a state, let's say California. You had a great year. You made 100 grand. You're feeling great. That's profit, man. And then you sit down with your accountant, and here's what actually happens. First, self-employment tax. The IRS applies the 15.3%. And you get a half deduction. So what you're actually going to get is 15.3% times $92,350. So you're paying tax in English, the 15.3 on 92.35% of your earnings. That's a really fancy way of saying you deduct half your SE tax. But here's how the numbers actually work out. And this is the way I think about it. For every $100,000, you're going to pay roughly $14,130 in self-employment tax. Right off the top. Boom. Ouch. I'm just going to write this down so you can kind of follow it. You just made 100K, and right off the gate, you're taking $14,100 off. That sucks. That's before income taxes, my friends, and it surprises a lot of business owners. They have no idea this is coming because they're like, oh, I don't pay that much in taxes. I don't have much federal income tax. But now we have to add in the federal income tax and the state. So after the SE deduction, your taxable income drops to $92,935. Then you get what's called the 199A deduction. This is the 20% qualified business income deduction under, you guessed it, Section 199A. And that is thanks to the Tax Cut and Jobs Act and the One Big Beautiful Bill. Thank you, right? That brings your taxable income down to roughly $74,000, a little bit over that. At current federal rates for a single filer, you're paying then about $11,700 in federal income tax. So your SE tax was greater than your federal income tax. And we see that a lot, especially when people are getting started, but we're not done yet. Because in California, and here's where it stings, California doesn't recognize the 199A deduction. That is right. California taxes all of your income. After this self-employment deduction, you're looking at roughly $8,500 in tax. And there's all these influencers out there going, oh, just buy a car. Nope, doesn't quite work that way. We'll get into that. But before you think, I hate California, there's no way I'm ever going to get California. California is not alone. I think only a handful of states, and it might be like 5, follow the federal rule for the 20% deduction. They don't have to. They don't care. They're like, hey, we're going to charge you state taxes. We're going to ignore that 199A 20% deduction. But so you add it all up. You got $14,100. It's actually $130 if I want to be precise. You got $11,700 and you got $8,500. So you're looking at roughly, what does that add up to be? About 34 and some change, right around $34,000. Ouch. So you kept $66,000, slow clap. And that is before you paid your health insurance, your retirement contributions, or any other personal expenses. And I've seen this, right? Somebody who left their job, they were making $100,000 a year. I've seen this so many times play it out, but it's usually somebody who's making good money, $150,000 a year, and they go out on their own and they start operating as a sole proprietor. They get what's called 1099 income, and they're very excited. But they call right around tax time and they're freaking out because nobody told them that they had to make quarterly estimated tax payments. Now they owe, let's just use the $100,000 mark, and let's say they owe that $34,000 and they don't have the money sitting around. And here's the part that really gets people. When you had that W-2 job, the taxes were withheld automatically. Every paycheck, it was gone before you even saw it. But as a business owner, nobody withholds anything. The money hits your account and it feels like it's yours. So I have a bunch of money in my account. I should be spending it. I should be doing things with it. I can go on vacation with it even. The IRS expects you to pay as you go. So they expect quarterly payments. And if you don't make them, they're going to charge you penalties on top of the tax bill. In fact, I just did a deep dive on all of the types of penalties that you have to worry about around tax time. And I'll put a link to it. It's a deep dive. We're going to get into the weeds on it, but it shows you how you get underpayment penalties, failure to pay penalties, failure to file penalties, plus interest. So it's all these penalties and interest you hear about. I do a deep dive. Now, you owe more for not knowing that the rule existed. So you're going to get hit not just with the tax, but you're probably going to get hit with penalties and interest. And if you don't file the return timely because you're freaking out and it's right around April 15th and you're like, oh shoot, I think I get until October 15th and you, God forbid, you don't file that extension, 5% a month penalty. Like, it's a lot. It's a lot. Now, there is a fix. It exists. It's called making an S-corporation election. Instead of paying self-employment tax on every dollar of your profit, you pay yourself a reasonable salary and you pay self-employment tax only on that. It's really employment taxes, because it's not technically self-employment tax, but it's employment tax on that salary. And then you take the rest as a distribution, and it's not subject to the employment taxes. On $100,000 of income, done correctly, this number is going to drop down to maybe $5,000. So you're going to save yourself between $9,000 and $10,000 if you do it right. And the savings grow as your income grows. And the problem is, most people find out about this like 3 years too late. By then they've overpaid $20,000 or more and that money is gone. In fact, I had a client in my office. This was like, I still remember this like yesterday. And he's sitting across from me. I look at his taxes and he was like, hey, Toby, can I meet with you? Can we just kind of do a review? And by the way, you guys can all do a review. I'll put a link in the show notes. It's not necessarily with me, it's going to be with one of my team members, but they're going to go over and they'll take a look, not go through all your taxes, but they'll look at a 10,000-foot view of how you're structured. It took me literally 2 minutes when I looked at how he was structured that he was overpaying his taxes. And it was close to $25,000 a year. Here's the funny part. He'd been doing it for over 20 years. And I said, his name was Mark, and I was like, Mark, why don't you make an S election? This is going to save you, and I just roughly, back of a napkin said it's going to be over $20,000 a year. And there's no way my accountant missed this. I've had the best accountant. I've been working with them for decades. There's no way. And I said, ask him. And so he called up the accountant. I was actually on speaker. I remember this like yesterday. He goes, hey, Ben, I believe that Toby's saying that I could make this change. It's one document that I could file. He was actually set up as an LLC, so he was structured correctly for asset protection, but he hadn't made the right tax selection. It was one form that he filed, an 8823, and all he had to do was file it. And he says, Toby's saying that if I did that and I paid myself a reasonable salary, I would save like $20,000 a year. And the accountant said, yeah, that sounds about right. And Mark got bright pink, kind of purple, and he said, why didn't you tell me about this? And the accountant said, you never asked. So of course he fired that accountant. But that's hidden tax number one. That's a big one. That's the low-lying fruit. What about number two? And I'm going to call this the deduction illusion. All right. Spending money does not save you money. I don't care what you see on TikTok. I don't care what you see on Instagram. Spending money does not necessarily, like, you get a deduction, but it's not going to save you money. It's the same thing as like, everything's on sale, I'm saving so much money. No, you're spending money. And I hear this stuff constantly. Buy a car at the end of the year. Make sure it's over 6,000 gross vehicle weight, yada, yada, yada. It's going to save you so much money. My accountant told me to buy something before December 31st so I can write it off and lower my tax bill. I have money sitting in the business. I can do this. I just don't want to pay taxes on it. So I'm going to buy something big. And let me show you exactly what happens. And I'm going to use an example. Let's just call him Jake. Jake has a great year. His business makes $200,000 in profit. And his accountant tells him he should buy a vehicle before the year end to write it off and lower his tax bill. Jake has the cash. He has $200,000 sitting in his account. So he buys a $200,000 G-Wagon in December. He uses it because you have to track your miles, you have to do your odometer, and you have to keep a mileage log. Use Mile IQ. I'll see if I can put the link in there too. Use Mile IQ because it's going to GPS track you. But he does it, and he used his car 75% for business at the end of the year because he did his homework. He knew that in order to get these big write-offs, you got to be over 50% business use. Now here's the hint. You got to do that for 5 years. You can't drop below that 50%. Ooh, but we'll get back to that later. Jake is excited. He thinks he's not paying taxes this year. Hey, accountant, I spent the $200K. That's what you told me, right? And here's what Jake doesn't understand. A deduction is not a tax credit. These are two completely different things, and confusing them is one of the most expensive mistakes I see business owners make. See, a tax credit, hey, if I do something and it gives me a tax credit, it reduces your tax bill dollar for dollar. A $10,000 tax credit means you owe $10,000 less on your taxes, full stop. A deduction, on the other hand, reduces your taxable income. So what you actually save, it depends on your tax rate. So Jake bought a $200,000 G-Wagon and used it 75% for business. This means he doesn't get to write off 100% of it. He gets to write off 75% of it. So the deductible portion is $150,000. That is his total federal deduction. Notice I said federal because right now we have Section 179 and 168K. We get this on a big, heavy vehicle like a G-Wagon. We're going to get a $150,000 deduction. So he spent $200,000. He gets a $150,000 deduction. So this is the math. This is what Jake missed. Jake is in the 24% federal bracket. So let's just do $150,000 times 24%. That's $36,000. So Jake spent $200K. He spent the rest of his money to save $36,000. Well, what about the other 140 some thousand bucks? You get no benefit. That is not a tax strategy. That is a car purchase with a little bit of a tax benefit attached, right? That I still remember this. I had a client, he was making like big money. It was 7 figures and he was spending it as fast as he could. Now, we didn't always have 100% bonus depreciation. So I still remember this. He bought a ton of equipment at the end of the year. So he had zero in his account. He goes, I'm not going to owe any tax. And it was like he had to depreciate that equipment over a period of years back in those days. And it was over $1 million. He was saving 30 cents on the dollar. So he spent $1 million. He was saving $300K. He still owed tax on the other $700K. And the money's gone. Now let me throw a little wrinkle. So remember, Jake is in California, which makes it even worse because California does not conform to the federal bonus depreciation rules under 168K. This bonus depreciation you hear about all over social media, it's a federal rule. Lots of states don't follow it. California never has, and it's not alone. Less than half of the states out there use bonus depreciation. In fact, California even says, hey, we're going to limit you on 179, like 25,000. So while Jake is writing off the full $150,000 business use portion federally, California is running in a completely different calculation. California caps Section 179 at 25K and uses its own depreciation schedule for the rest. Jake's California deduction in year one is a fraction of his federal deduction. 2 different tax systems, 2 different answers, and his accountant only told him about one. Go out and buy a car, right? And by the way, and I see this all the time, there's a influencer out there who always says, I pay no tax. I make $1 million and I pay no tax. And he's doing a bonus depreciation. He's going to be shocked when he discovers that his state tax bill is going to be as big, or if not bigger, than his federal tax bill. And yes, he's going to owe taxes because there's all sorts of little nuances. When this guy's talking about, I do real estate and I get this big write-off, it's capped. It's capped. You can only take so much. There's a net operating loss limitation, and it doesn't work for your state taxes. And it doesn't affect self-employment taxes at all. Now, here is where Jake's stories gets worse, because it's not over yet. And that is hidden tax number 3. And this one nails people. And it's called recapture. What is recapture, you might be asking? Well, it's the most dangerous of the 3 because it can arrive long after you have forgotten about the original deduction. And when it arrives, it's bigger than most people expect. And let me explain this. I'll use Jake as the example. So Jake drives his G-Wagon that first year, right? He buys it in December. His accountant said, buy a big car at the end of the year. I just had a realtor walk up to me and said, I should have bought a car at the end of the year. My accountant told me to do this. I was like, thank God you didn't. Fire your accountant. Jake took the full $150,000 federal deduction. Remember, he got that $36,000 of benefit. Yay, Jake. Year 2 comes around. And here's the problem. He bought a G-Wagon. It's not a work truck. He has an old beater truck that he uses for his work. In fact, maybe his wife drives the G-Wagon, or maybe somebody else drives it. It's not for work. In fact, Jake barely uses the G-Wagon for business at all because it's just not a work truck. It sucks gas. The insurance is nuts. And it's like he spent a lot of money. He bought a really nice car. And by the way, if you think G-Wagon's crazy, do a Range Rover. Fill in the blank. Some big car that somebody's saying is the 6,000 gross vehicle weight, right? At the end of year 2, his business use drops to 25%. Now, the IRS has a specific rule for this. When the business use on a car, which the IRS calls listed property, because it's more personal, like they know this is the type of property that people are going to try to play this game with. If it drops below 50% in any year after you claimed the accelerated depreciation during its useful life, 5 years for a car, the IRS requires you to recapture that depreciation, that is in excess of the normal 5-year depreciation. So he took this big 150, most of that comes back as taxable income immediately, right now as ordinary income. So remember the situation. Jake had 200 grand, he bought a $200,000 car, he saved some money, now he's gonna owe close to that amount, and his money's gone the following year. And the IRS goes back to year one. They calculate what Jake should have deducted if the business use had been lower from the start, if he had never met that 50%. So the difference between what he actually claimed and what he should have is ordinary income. Boom, crushing. And by the way, this works on a ton of stuff. It's not just cars. You have recapture on property, real estate, on equipment, you sell it. And so on a car he is barely driving for business anymore, he gets a $30-some thousand tax bill. So I still remember this. I had a client who was running a very successful business. End of the year, they bought the Range Rover for business, but it was really for his wife. In year two, he got a massive tax bill, and the money had already been spent on the Range Rover because he'd had a good year, then he had a not so good year, and was absolutely in dire straits. It was destroying his business. He never would have bought the Range Rover in the first place had it not been for some knuckleheaded accountant saying, hey, you want to lower your tax bill at the end of the year? Buy some stuff. Don't. The lesson is, I shouldn't say this. It's not that you should never buy a vehicle for your business. That is not the lesson. The lesson is you need to plan before you write the check. Document your business use, meticulously every single year, because you have a requirement to do that. And by the way, if you don't, you get no deduction. And understand that the IRS tracks this. They know that there's people out there that are really easy to hammer. And by the way, when they audit sole proprietors, they win 94 to 95% of the time. And this is one of the things they're looking at. They just go after they know that these people don't know the rules. And the deduction that you took in year one, it looks good. It doesn't disappear. The tax issue could follow you. And this is true for you real estate investors. When you own investment real estate, the IRS allows you to depreciate, let's just say your residential property over 27 and a half years. If it's non-residential, commercial, 39 years. And you deduct a portion of the building's value every year. That's the kind of like the what everybody does. And it reduces your taxable income year after year. It's one of the best ongoing. But there's a way to take it further. And a lot of investors do what's called a cost segregation study. They hire an engineer to perform a cost segregation study. And the study breaks the property apart into components that are the 5, 7, 15-year components. They reclassify things like flooring, cabinetry, lighting, the parking areas, land improvements as shorter, lived assets in this 5, 7, and 15 instead of 27 and a half or 39. And then they combine that with bonus depreciation, where you can write off all of it in year one, and you can generate a massive deduction in year one. It's usually about 30% of the improvement value on that real estate. And yes, this is where it gets really powerful. If you're a business owner and you own your own business, you can group that huge loss with your business and write it off, which is extremely smart unless, and let me just do the unless, we'll use another example. Let's say Maria. Maria is a business owner. She owns a property that she leases to her business. So she owns the building and she leases it to her business. And she has a good accountant, and she does a cost segregation study, and she groups the business and the real estate together. In between the reclassified components and the bonus depreciation, Maria generates a $300,000 deduction in year one that offsets her business income. So her tax bill drops dramatically, which is great. She saves tens of thousands of dollars. She's thrilled. Actually, she saved over 100 grand. And then a few years go by, and Maria is bursting at the seams, and she needs to move her business. But hey, it's boomtown, right? And she can't afford the crazy cost of real estate in her town anymore. She has her old building, but hey, I really need to grow my business. And she decides to rent a new space rather than buy, and she sells her old building. And in real estate, this is the big one. You never just sell your building. You're always going to trade it for something, do a 1031 exchange, or you're going to buy more real estate to offset that. But what she does is she sells it. And she doesn't replace it. She doesn't buy any more real estate. She just rents a place. And her accountant has to sit down with her. And of course, he's going to have to tell her right at closing, hey, the IRS views depreciation as deferred tax. It's not a forgiven tax. Every dollar of depreciation you took during ownership is tracked on a running total called accumulated depreciation. When you sell that building, the IRS wants a portion of that back. It's called depreciation recapture. For real estate that is depreciated using just the regular old 27.5 year or 39-year number that is called straight line, the recapture is taxed at a maximum rate of 25%. That is called unrecaptured Section 150 gain. It is higher than that 0, 15, or 20% long-term capital gains rate, the highest being the 20%. So most investors are expecting, hey, if I sell a property, I'm going to have capital gains. It's not going to murder me. It's going to be 15%. It could be 25% for unrecaptured. But remember, Maria did a cost segregation study, and I love cost segregation studies, but those components are now personal property, and they fall under Section 1245 of the tax code. So fixtures, equipment, short-term or short-lived assets, things that are 5, 7, 15 years, the recapture on those is taxed at ordinary rates, just like the G-Wagon, remember? Right, and so Maria's bracket, she could be getting hit 30% plus. So Maria has 2 layers of recapture hitting her at the same time. She's got 1250 recapture at 25%, 1245 recapture at her ordinary rate, and she's still got long-term capital gains on the rest. So a significant portion of that $300,000 deduction she took years ago is now coming back as taxable income tax at the rate she never anticipated. Hey, I'm going to get hammered on this. And here's the part that stings the most. Maria, she could have bought a replacement property, but she's not. She's renting something new. So she can't use that 1031 exchange that was open to her. The 1031 exchange requires a like-kind replacement property. Maria does not have one. So the full recapture hits in the year of the sale. At the closing table, you're sitting there, oh crap, I'm going to get nailed. The deduction was real. The tax savings were real, but the recapture was always sitting there waiting. And investors who win with cost segregation are the ones who plan the exit before they plan the entry, which usually means not selling or only selling if you're investing more. Or you have you can do an exit plan like do an installment sale. So you're spreading it out over time, but it is definitely not selling when your tax bracket is the highest and you do not generate enough money from the sale to cover your taxes. That's for sure. Right, so here's where we land. 3 hidden taxes. We have the 15.3% self-employment tax. We have, number 2, the deduction illusion. And we have recapture. And it just nails you. So the recapture, the deferred tax bill that arrives years after the deduction, and it felt like a victory, and now you're getting bammed, you're getting hit. None of these are accidents. They're all predictable. They're all avoidable with the right structure and the right advice at the right time. The people who avoid them are not lucky. They just knew they were coming. By the way, if someone you know just bought something expensive, maybe it was at the end of the year or because their accountant told them they could write it off, please send them this video. One conversation could save them real money. And drop in the comments below, just tell me which of these 3 hit the hardest for you, or that you know of somebody that got nailed by them. And by the way, if you're not subscribed yet, here's why you should be subscribed to this channel. I publish new tax videos and new videos on asset protection and legal moves that protect what you've built every week. It's usually 2 to 3 videos every week. Most people find out about these things after they've already made the mistake, so subscribe so you're ahead of it. And before you go, I have 3 things that are completely free that I want to offer you. Number 1, the Tax and Asset Protection Workshop. Anderson's been teaching it close to 30 years. It's a live virtual event now where my team walks through the exact strategies we use with real estate investors and business owners. Second, and by the way, it's a 1-day class. They're typically on Saturdays and they're absolutely free. I'll put the link in there in the show notes. The second is a free strategy session with one of our advisors. It's not a sales pitch. We just answer specific questions about your situation and create a blueprint for you. Third, a free ebook you can download right now. I'm just going to throw that in there. I'm going to put the 3 steps to becoming an invisible investor. All 3 links are in the description below. Good luck, guys.